You ever get that sinking feeling in your stomach when you look at a medical bill? I mean, even when you have good health insurance? Well, there's a special kind of plan out there designed to fight that exact feeling. It's called hospital indemnity insurance, and we're about to break down exactly what it is, how it works as a cash safety net, and, most importantly, who it's really for.
It's a question that can drive you crazy, right? You do everything you're supposed to. You pay those premiums every month. You stick to the in-network doctors, and still, one trip to the hospital can leave you staring at a mountain of unexpected costs. Well, it turns out there's actually a name for that exact problem. And that name is financial friction. It's all about those hidden costs that pop up when you least expect them, and it's the whole reason a product like this even needs to exist. So, financial friction isn't about the cost of the surgery itself. Nope. It's about everything else. It's that huge deductible you have to pay out of pocket before your insurance even kicks in. It's the coinsurance you owe. It's the gas money to get to and from the hospital, the ridiculous parking fees, maybe even a hotel room for your spouse. It's all those little things that just pile up and create this huge financial shock, right when you should be focused on one thing and one thing only: getting better. Okay, so if financial friction is the villain of our story, how do you fight back? Well, that's where this idea of a cash safety net comes into play. Now, the definition here seems pretty straightforward, but I want you to focus on two words: directly to you. That is the absolute game changer. It's what makes this completely different from the health insurance you're used to. This plan has a totally different job. And this right here shows you that difference perfectly. Your normal health insurance, it pays the doctors, it pays the hospital, it handles all the medical billing. But a hospital indemnity plan, it pays you. It sends a check directly to you when a covered event happens, like you get admitted to the hospital. And then, and this is the best part, you decide what to do with that cash. Pay medical bills, cover your mortgage, buy groceries, it's your call. Cash stabilizer is the perfect way to look at it. Think about it. When a health crisis throws your entire life off kilter, this provides a predictable, stable chunk of cash to help you get your feet back on the ground. It's literally designed to absorb that out-of-pocket shock and fight all that financial friction we were just talking about. Okay, now listen up, because this is probably the single most important thing you need to understand about these policies. It's where almost all the confusion happens. We're going to call it the observation versus inpatient trap. Let's walk through a super common scenario. You go to the ER. They decide they need to keep you for a while to run some tests and monitor you. So, you're in a hospital bed, maybe for a whole day. To you, it feels like you've been admitted, right? But here's the crazy part. The hospital might classify you as being under observation, which technically is an outpatient service. You only become an inpatient after a doctor officially writes the order to admit you. And that one little word changes absolutely everything. And really, this is the biggest gotcha of them all. The number one surprise people run into is not understanding that difference between being under observation and being formally admitted as an inpatient. Why? Because that one little classification by the hospital is what determines how or even if your policy pays out. And here's what that looks like in dollars and cents. Let's say you're in the hospital for 20 hours under observation. Your plan might pay out a smaller, specific benefit for that. But if you're formally admitted as an inpatient for 2 days, that could trigger the full, much larger daily benefit. So this is critical. If you're ever looking at one of these plans, you have to know if it's designed to pay for both situations. Otherwise, you could be in for a very nasty surprise. All right, so the good news is these plans are not one size fits all. Not at all. You can actually build a policy that's customized to cover the exact things you're most worried about. And the way you do that is by adding things called riders. Think of them like optional upgrades you can bolt onto your main plan. So for example, you can add a rider that pays you a benefit if you need an ambulance, or one that helps pay for your stay in a skilled nursing facility while you recover. You can even add coverage for things like outpatient physical therapy or practical support like travel and lodging for your family. You get to pick and choose what matters to you. And that's really the power of it. By picking the right riders, you can basically design a plan that covers the entire journey of a medical event, from the moment you step into the ER all the way through your very last rehab appointment. So, with all that said, let's get down to the bottom line. Who is this stuff actually for? Who gets the most value out of this kind of plan? Well, it's a really popular choice for a few specific groups. You've got Medicare enrollees who use it to get cash to help cover their deductibles and copays.
You have people with high deductible plans from work who use it as a financial buffer. Caregivers absolutely love the cash flexibility it gives them to deal with missed work and all the other disruptions. And finally, it's a great fit for planners, people who just want a simple, predictable cash payout they know they can count on.
And hey, for anyone getting close to retirement, this is a huge pro tip. A lot of insurance companies have something called a guaranteed issue window, which is usually right around your 65th birthday. Here's the key. During that window, you can often get the base hospital plan approved with no medical questions asked. That's a massive advantage that makes getting covered way, way simpler right when you're moving over to Medicare. At the end of the day, this whole conversation isn't just about one type of insurance plan. It's really about being prepared. It's about looking at your own situation and being honest. So whether the answer is a plan like this or just building up a bigger emergency fund, the real question I'll leave you with is this. What's the biggest gap in your financial safety net? And what's your plan to fix it?